The HLL has rupees 8 crore 10% mortgage bond outstanding. So information is provided to us. A company is having rupees 8 crore mortgage bond outstanding. Rate of interest is 10% under an open-end scheme. The scheme allows additional bonds to be issued as long as all of the following conditions are met. So a few conditions have been provided to us. So unless all the conditions are met, you are not entitled to issue any new debt financing. First, pre-tax interest coverage, that is income before tax plus bond interest upon bond interest, remains greater than 4. Net depreciated value of the mortgage asset remains twice the amount of the mortgage debt. Third, debt to equity ratio remains below 0.5. The HLL has net income after taxes of rupees 2 crore and 40% is tax rate. Rupees 40 crore in equity, 30 crore in depreciated asset covered by the mortgage. Assuming 50% of the proceeds of the new issue would be added to the base of the mortgage assets and that the company has no sinking fund payment until the next year. How much more 10% debt could be sold under each of the three conditions? That is the first question. Second question is, which protective covenant is binding? That is the question. Everybody is requested to go through the question, then we will discuss how to do it. Just go through the question, don't solve it. There is a question from a student that say, so what is the open-ended scheme? The term open-ended scheme means that regular sale and repurchase is possible by investor with the company. That is given a name as open-ended scheme. Means the funds of the investor is not blocked in a way that say, if at all I have purchased the bond for this company and I want to sell that bond, then in that case I don't have to go in the market to sell it. I can go to the company itself and I can sell the bond. That is what we understand is a term open-ended scheme. That is what they have provided. Let us have understanding that say what is the question about. The question is providing an information like this. There is a company called HLL. This company has already issued debt financing. Information is given that said this company has already issued debt financing. The debt financing that it has is an amount of 8 crore and the rate of interest is 10%. Whenever we had issued the debentures, at that point of time, we had given a kind of binding that we will always make sure that say we will always meet with these three conditions. The question is providing the information that say the company wants to raise further debt financing. Information is given that says earning after taxes is 2 crore. Income tax rate is 40%. Then 40 crore of equity. Then 30 crore in depreciated asset covered by the mortgage. So the assets 30 crore covered by the mortgage. and assuming that 50% of the proceeds of the new issue would be added to the base of the mortgage assets, and company has no that is sinking fund. How much more 10% debt could be sold under each of the three conditions? Means we are required to make the calculation. Let's say suppose there is only first condition. Then in that case, what is the amount of the additional debt financing that we can issue? Suppose there is only second condition. What is the amount of the debt financing that we can issue? And suppose there is only third condition. Then in that case, what is the additional debt financing that we can issue? That is a question. So in the first question, there are three questions. Then we have been provided with the information about the second question that I will explain you slightly later on. Please write an answer of the question. First point. In this question, we have to compute that what is the additional debt finance that the company can obtain based on individual condition. Full stop. Second point, we have to take each of the condition separately. Full stop. Now friends, I want you to tell me that based on the first condition, what is the amount of the additional debt financing that can be raised using the first condition. Friends, the first condition is that the pre-tax interest coverage, that is technically called interest coverage ratio, remains greater than 4. It is good, let's say they have provided the formula, even otherwise we note that formula. So write on heading calculation of additional debt financing as per interest coverage ratio. In the write down, assuming that additional debt financing is of rupees X, comma, answer is calculated. Dear students, the formula is given like this. Interest coverage ratio is equal to EBIT upon interest. That is EBT plus interest is EBIT. and it should be greater than 4. I'm sorry, interest coverage ratio should be greater than 4. Okay. So EBIT upon interest should be more than 4. So for the time being, we have to keep is equal to sign over there. It is EBT plus interest upon interest is equal to 4. Why? Because interest coverage ratio should be greater than 4. What is EBT? It is earning after taxes upon 1 minus T. That is EBT plus what is the interest amount? It is 8 crore into 10% plus X amount into 10% whole divided by existing interest 8 crore into 10%, additional debt financing of X, and for that also the rate of interest is 10%, and keeping is equal to 4, we are required to make the computation of the X as balancing figure. We have been provided with the information, friends, that earning after taxes is 2 crore. Then you have been provided with the information that income tax rate is 40%. So these two information are sufficient to compute the EBT value. So over here 2 crore divided by 1 minus 0.40. So this is EBT plus 10% of 8 crore comes to 0.8 crore plus 10% of X is equal to 0.10X whole divided by 0.8 crore plus 0.10X is equal to 4. Now in this equation, X will be found as balancing figure. So we understand that over here it is 2 crore divided by 0.6, that is 3.33 crore plus 0.8 crore plus 0.10X divided by 0.8 crore plus 0.10 into X is equal to 4. So 0.8 plus 0.10X is transferred on the left hand side. So it is 3.2 crore plus 0.1040X is equal to 4.13 crore plus 0.10X. 0.10 is transferred on this side. So what will happen? It will become negative. 3.2 is transferred on this side. So again it will become negative. 0.4 minus 0.1 is 0.3 is equal to 0.93 crore. So X is equal to 0.93 crore divided by 0.30. That comes to 3.1 crore. So value of the X is 3.1 crore. Now friends, I want to know from you that with the first condition, additional debt financing of less than 3.10 crore is permissible, up to 3.10 crore is permissible, or more than 3.10 crore is permissible. What is the answer with the first condition? Dear students, the answer is less than 3.10 crore. Why? Because you read language of the question carefully. You are required to keep the interest coverage ratio which is more than 4. In a way that say we understand that say, I'm sorry. So we understand friends that say the interest coverage ratio should be greater than 4. So over here we understand that say, I'm sorry, this is a wrong sign. This should be greater than 4. It means that interest coverage ratio should be greater than 4. And how do we compute the interest coverage ratio? It is calculated like this: earning before interest and taxes upon interest, and this value should be greater than 4. This is what we understand. Now basically we cannot solve this greater than sign, so we put is equal to for doing answer. Now when we put is equal to and we do answer, it means that say when you are going to raise the debt financing of exactly 3.10 crore, the coverage ratio will be 4. If at all you raise the debt financing of exact 3.10 crore, then the coverage ratio will be 4. But you are not allowed to keep the coverage ratio of 4. Your coverage ratio should be greater than 4. As it is supposed to be greater than 4, so the additional debt financing which is permissible is less than 3.10 crore. That is what we understand. Please write down with paragraph. ICR, interest coverage ratio, should be more than 4. Full stop. ICR will be 4 if additional debt financing is rupees 3.10 crore. Full stop. Hence, additional debt financing should be less than 3.10 crore permissible with first condition. Full stop. Now I want you to tell me answer for the additional debt financing permissible with the second condition. I want you to tell me the answer. Now let us understand the additional debt financing permissible with the second condition. Chalo, please write down answer. Calculation of additional debt financing permissible with second condition. It specifies that net depreciated value of the mortgage asset remains twice the amount of the mortgage debt. So the condition specifies like this: mortgage assets is greater than equal to two types of debt. That is the condition. Now the question is providing the information like this, that it has rupees 30 crore in depreciated asset. So it is 30 crore is the depreciated asset. We have to keep a sign of is equal to in between. Two types of debt. So 2 into debt financing is right now 8 crore and the new debt financing is rupees X. Okay. Language of the question says that say 50% of the proceeds of the new issue would be added to the base of mortgage assets. Means whatever the amount that say we raise, of that 50% will be used to buy the assets and those assets will be given in form of mortgage to the investor. So 30 crore plus 0.5x. Why? Because it is only 50% provided to us. Okay. So now it is 30 crore plus 0.5x is equal to 16 crore plus 2x. Okay, 0.5 is transferred over here. 2x minus 0.5x is equal to 30 crore minus 16 crore. 2 minus 0.5, that is 1.5x, is equal to 14 crore. X is equal to 14 crore divided by 1.5. So over here 14 crore divided by 1.5. That comes to 9.33 crore. That is the additional debt financing permissible with the second condition. I want you to tell me less than, up to, or more than. Now friends, over here the answer would be up to 9.33 crore. Why up to 9.33 crore? Because language of the question says that the mortgage assets should be greater than equal to two types of debts. Two times of debt. It means that it can be two or more than that. So when you raise the debt financing of exactly 9.33 crore, then in that case, we understand that the coverage ratio will be 2 and you are allowed to keep the coverage ratio of 2. So we understand that the answer is 9.33 crore. I want you to answer for the third condition. What is the additional debt financing permissible? Next, debt to equity ratio. Debt to equity ratio. The question is providing the information that it should remain below 0.5. So it should remain below 0.5. So the formula is debt upon equity, and for the purpose of solving equation we keep is equal to. Now what is the debt financing? We understand it is 8 crore plus x. What is equity financing? It is an amount of 40 crore is equal to 0.5. So now 40 crore is transferred over there. So it is 8 crore plus x is equal to 40 crore into 0.50. So x is equal to 20 crore minus 8 crore. That comes to an amount of 12 crore. So the additional debt financing is permissible with this condition is less than 3, that is less than 12 crore. Why? Because we understand that the coverage ratio should be below 0.5. When you raise debt financing of exactly 12 crore, the coverage ratio will be 5, which you are not allowed to keep. So the additional debt financing permissible is less than 12 crore. So the right answer, additional debt financing. Of less than rupees 12 crore is permissible. Now let us see the second part of the question. It says that say which protective covenant is binding. Anybody can explain the question to me before I proceed for the answer. So friends, over here the second part of the question says like this. Listen carefully. We understand that all these three conditions are required to be met for the purpose of raising additional debt financing. All the three conditions are required to be met for the purpose of raising additional debt financing. We understand that, listen carefully, we understand that the lowest among the three is the highest amount of the debt financing that you can raise. Because lowest among the three is the amount which will satisfy all the conditions. And the lowest is less than 3.10 crore, which is provided by the condition of the pre-tax interest coverage. So the question says that say which protective covenant, it means that which condition is binding. So the condition which will bind you to raise the additional financing beyond 3.10 crore, or we can say that say the 3.10 crore or more than that, is interest coverage ratio, and that is the answer for the second part of the question. Is that an answer? Over here, we are required to identify that which condition limits the company from raising of additional debt finance. Full stop. We understand that the condition which gives lowest amount is the maximum debt financing that the company can raise. Full stop. It is interest coverage ratio in this example. Full stop. condition 1, condition 2, condition 3, additional debt finance. It is less than 3.10 crore, less than equal to 9.33 crore, and less than 12 crore. So the first condition is binding the company. So the answer is interest coverage ratio. This is what we understand. Dear students, we understand importantly that over here that we are required to identify the condition which will restrict the company from raising the additional debt financing. Now friends, understand the logic of the question, this entire question. The logic is like this, that there is a situation in which a company is basically going for the debt financing. There is a particular financial situation at which point of time the company is going for the debt financing. Now suppose the debt financer has seen that right now the amount of the equity proportion is very high and the amount of the debt proportion is comparatively less, very less, negligible or nothing. At this point of time, let us say that the Mr. X is giving loan or subscribing the debentures. Now later on what happens at this company is going on further raising the debt financing, further raising the debt financing, further raising the debt financing, and one fine day this company is going into the liquidation because of the wrong decisions that they have taken regarding raising the additional debt financing with a point that in future we will earn. But unfortunately the company could not meet with its commitment and the company closes down. Now over here lender Mr. X is depending, let's say basically when I had made investment in debentures, this company was having very less amount of the leverage, but later on the company raised too much debt financing. So next time onwards, what Mr. X started doing, friends? Mr. X started telling to the borrower that every time you have to make sure that you are required to keep the coverage ratio, that is interest coverage ratio, greater than 4. You have to keep the mortgage assets at least 2 times of the debt. You have to keep the debt equity ratio below 0.5. So always you must make sure that you have strong financial position. Only in that case I will allow you to withdraw, I will allow you to borrow further. If at all your financial position is not strong and you still want to borrow, I don't mind, but first of all you repay my amount, because I know that you take some FSR decision and ultimately I suffer a loss. That is the reason these conditions are kept, and always for these conditions the answers are going to be like this only: less than 3.10 crore or less than equal to 3.10 crore, something like that. In no case the answer would be more than some amount. The conditions will always restrict you from raising the additional debt financing. So in no case the answer would be more than 3.10 crore. That is what we understand logically. See, nowhere in the question we are required to write all these things which I am explaining to you. But as a student you need to have that understanding that what the entire question is about. Students who are going to opt for elective paper as 6A, in that risk management is the paper, in that many a times you are going to come across a word which is given a name as protective covenant. At that time you can relate this portion with that reading. You will be able to have really fantastic understanding of the word protective covenant that they have used over there.